Hi everybody, it's Miranda Love here with Cougar Mountain Software. Welcome to the second of 3 webinars in Cougar Mountain Software's series on fraud prevention featuring forensic accountant Denise McClure. We're excited to have Denise with us today. She has 30 years of experience in public accounting, business management, and nonprofit board involvement, and is a certified public accountant and certified fraud examiner who focuses on reducing risk by creating checks and balances in financial processes and teaching business owners, boards of directors, and employees how to achieve transparency and accountability. Today's topic is focusing on the importance of fraud deterrence. Our next webinar in this series on fraud prevention is scheduled for March 7th, where she'll talk to us about the culture of integrity, the foundation for building accountable and transparent organizations. At the end of Denise's presentation, you'll be able to assess your organization's fraud preparedness with a short poll followed by questions and answers with Denise. Feel free to go ahead and type in any questions you may have in the chat box, and we'll get to those in the end. And without further ado, I'd like to turn it over to Denise McClure, our featured presenter. Thank you, Denise.
Thank you, Miranda. Well, welcome everyone. This is the second presentation, as Miranda said, on fraud prevention. And we'll be building on the webinar from 2 weeks ago where we discussed nonprofit board member duties, the fraud triangle, and some fairly high-level tools for mitigating the risk of honest errors and dishonest acts. Today we're going to focus primarily on deterrence. How do you encourage good behavior and discourage bad behavior by heightening the risk of consequences for that behavior? So if someone in your organization could take advantage of their position and your trust, what could you do to deter them from doing so? So briefly, we're going to review the fraud triangle, the purpose of internal controls, and I have a couple of case studies for you, and then I have several tips on deterrence and early detection. If deterrence fails and you can't prevent somebody who could embezzle from you, then you want to rely on tools that will allow you to detect it much more quickly and reduce your risk of loss. So the fraud triangle was developed by Donald Cressy, a criminologist in the 1940s who interviewed about 200 people who were in prison for embezzlement. And he determined that there were 3 elements necessary for someone to commit fraud. The first is financial pressure. It's not just any financial pressure, it's what he called non-shareable. So if somebody has a gambling addiction, if they have a shopping addiction that's fueled by depression, if they're drowning in credit card debt, if there is a foreclosure looming, if their husband day traded away their kids' college funds. You can laugh at that, but that happened to some friends of mine. There's something going on in their lives that they feel like they can't share with anybody else. So it's a non-shareable financial pressure. If they see an opportunity to solve that dilemma with your organization's funds, the rationalization piece is easy. They tell themselves, I'm just borrowing the money, I'll pay it back. Or they may have an entitlement issue where they say, life's not fair, and this is just going to even the score. So if you have somebody who has a non-shareable financial pressure, they see or perceive of an opportunity to resolve their problem with your funds, and they are able to rationalize it, chances are their path could lead towards embezzlement and your loss of funds for your organization. And internal controls are not just about fraud. They're much broader than that. Internal controls are about financial stewardship. They require balancing efficiency and security, and overall they create a work environment that protects all the stakeholders. So they would protect owners, shareholders, boards of directors, employees, vendors and customers, any donors, and the beneficiaries if you're a nonprofit organization. So overall, internal controls help an organization achieve its mission. Internal controls involve 3 elements. The first is to have a culture of integrity, and as Miranda said, we're going to talk about that more in a couple weeks. And today we're going to focus on how we can segregate duties so that no one controls a transaction from beginning to end, and how you can institute some oversight and monitoring provisions in order to create a perception of detection. Now in the fraud triangle, that perception of opportunity is the one element that business owners can control. They don't control somebody's financial dilemmas, and they don't control the rationalization that people use to perform dishonest acts. So when you talk about monitoring or creating a deterrent effect, you talk about a perception of detection. You want to create the perception in your employees' minds that if they did try to solve their opportunity with your funds, that they would quickly be caught or could easily be caught. And so it raises the risk of being caught in their minds. You need all three of these things to have a good system of check and balances, but it's a balancing act, and every organization is different. How you implement checks and balances in your organization will be different based on the type of accounting system you have, the skills and abilities of your employees, and several other factors. So there's no one right way to do it. In our last presentation, we talked about a mother-daughter team in a nonprofit alcoholism and treatment center, and this team, primarily the mother, stole $1.5 million over 5 years. Their non-shareable financial need was that they were interested in race cars, and they had several race cars and were well known among the local speedway enthusiasts. They stole $1.5 million through very simple schemes. They wrote checks to themselves. They paid off their personal credit cards with their company funds, and they paid for personal expenses on company credit cards. There was really no need to try to hide or conceal what they'd done because they were the only ones who looked at the books. They controlled all the transaction processing from actually receiving the mail to processing checks, doing payroll, processing receipts, and preparing reports and doing reconciliation. So they controlled the entire accounting transaction process. The mother especially was a long-term trusted employee, and the executive director was going through cancer treatments while this was going on. So even though she had been a model employee for 13 years, for the last 5 years of her 18-year tenure, she stole $1.5 million. This is a case where there were no internal controls, and the long-term trusted employees had complete control to all the accounting procedures. There's another case, in case you think that only nonprofits are at risk for fraud. There's a case in Milwaukee where it was a company, a small public company actually, who has about, at the time, had about $40 million per year in revenue. So a good size organization. And their top financial person stole $34 million over 5 years. And she did it primarily by transferring funds from the organization, from the company, to a credit card company. So she paid off her personal credit cards with wire transfers from the company to the tune of millions of dollars. And there were also some cashier's checks involved. So again, these aren't involved schemes. The concealment strategy was much more difficult, obviously, but she also had complete control of the accounting system. They had a very poor quality accounting system where they couldn't use it to segregate duties, enforce segregation of duties, or print valid reports and reliable reports. And there was almost no oversight. And as we'll talk about in a minute, the CEO of the organization went on a news program and told listeners that he was proud that he had never, ever, ever looked at a bank statement. So we'll bring that up again in a few minutes. But this is another example where even though they had some internal controls, the internal controls were not enforced. Nobody was monitoring whether people reviewed cashier's checks and wire transfers and things like that. And so it, again, like the Alcoholism and Treatment Center, was a license to steal. Effective deterrence involves the trust but verified principle. And in this case, we're going to look at the creating a perception of detection so we can figure out how the mother-daughter team in our first case study could have been deterred from stealing, or how in the second case, where the perpetrator had depression and probably some other mental health issues and would go on these shopping sprees that would pale in comparison to any of the shopping sprees I've ever done. Because she would buy jewelry and she would go into high-end boutiques, and if she saw something she liked, she would buy 4 or 5 or 6 outfits in different colors and different sizes. And they found a lot of that clothing stuffed in closets and in her credenza at work and other places. So it was not a rational spending by any stretch of the mean. Your employees know where the weaknesses are in your organization. So what we're trying to do in creating a perception of detection is to counter that perception of opportunity by a otherwise honest employee or volunteer and create a perception of detection that will deter your employees from taking advantage of any perceived weaknesses that they see in your organization. So what are some specific tips that we could use to create a perception of detection? Well, tip number one is to look at your bank statement. Unlike the CEO who went on television and bragged that he had never looked at a bank statement, I strongly recommend that someone review your bank statements. Now, there's lots of ways you can do this. I'm going to bring up some of the best practices that I recommend to my clients. I recommend that the person who does the reviewing, I'll call it your independent reviewer, is not involved in your accounting process whatsoever. That this individual would either personally download statements or they would receive them in the mail unopened, possibly sent to their home or sent to your office and they would receive them unopened. I recommend that you make it easy on the independent reviewer to scan the check images. And if you write 20 checks a month, it wouldn't be so hard to open up each canceled check on the online banking system and look at it. But if you write 100 checks a month or 150 checks a month, that's a little harder. So if you obtain for them the bank statement that includes the check images, the person could either review that online very easily by scanning through the pages or review the hard copy. Another best practice is that the independent reviewer will ask questions and look at support for specific transactions. They can pick a few transactions at random. They can pick transactions that they feel are high risk, so it could be any computer equipment purchases, anything from any large box store. They can look at specific travel charges on credit cards and receipts for dinners and things like that. I also recommend that they confirm that payroll tax deposits are being made routinely, because one of the ways that the nonprofit case study with the mother-daughter team, one thing they did in order to get cash to steal was to stop making payroll tax deposits. And since they controlled the mail and the tax commission people that came to the door and asked for them, and they controlled everything. And so the executive director didn't know that they weren't making payroll tax deposits, and they had a $600,000 deficiency with the taxing authorities. So these are some of the best practices. Remember that if you use an accounting system like QuickBooks or some of the Sage products, you can print a check to yourself, and I can make myself the payee. I can print it out, take it to the bank and cash it. I can immediately go into the accounting system and change that payee. So looking at the check images is really critical, because you want to find out who was really paid, not just who your accounting system says was paid, if your accounting system doesn't have good internal control built in. The second tip is on check signing. Never, ever, ever sign checks without reviewing the full supporting documentation. That would include the invoice, the receiver, any shipping documents. If your organization uses purchase orders, then it would include the purchase order as well. Always ask questions if you don't understand something or if something looks familiar. You can always ask someone to pull the vendor file and look at prior invoices to make sure you're not paying a check twice. In addition, don't fall for a check ambush. We talked about this in the first presentation, but a check ambush is when somebody comes to your office, if you're the check signer, at the last minute when they know that you have to leave, and they ask you to sign a whole stack of checks and apologize profusely because, gosh, the printer messed up or you've lost track of time or whatever the case may be. In that case, I would recommend, if someone does that, to just gather up all the documents and take them with you and mail them yourself after you've had a chance to review the documentation and sign them. Finally, because I've had a recent case where there was a signature stamp involved, if you do have a signature stamp, please shred it and get rid of it and make sure that no one prints another one for you, because they can be too easy to sign your name to a check that should never go out. Tip number 3 involves preparing the deposit, and this is designed to protect your revenue stream. If you don't have accounts receivable in your accounting system, as a lot of nonprofits don't, maybe donations that are received through the mail or collected in an event could very easily go missing. And in order to avoid that, you want to have somebody who's independent of related processes. So that would be independent of cash processing, independent of accounts receivable processing, independent of donor acknowledgments or being able to make master file changes, and independent of the bank reconciliation process. So somebody who's independent of all those things, maybe a receptionist or an intern or someone like that, would receive the mail, sort the mail, prepare the deposit, restrictively endorse all the checks, and then create some sort of detailed log of receipts that you could use later as an audit trail. So if your accounting system doesn't provide the user security that's required for something like this, you would want to be able to create your own log of receipts. Now, the log of receipts could take a lot of separate forms. The best case scenario is if you can limit accessing your accounting system so that you can give this independent person access to only your deposit screen and they could enter the deposits that way, then you could print a report, scan it in to your reviewer, or somebody could just look in the system for it. But you have to be able to lock down user security pretty easily in order to make something like that work. An alternative would be to have a cover sheet where you photocopy all the checks that you received in, and maybe you fan out the cash that was received and scan that and send it to your independent reviewer. You can also prepare a list in Excel. Any type of log that can't later be changed so that you have it in case you want to do a little mini audit of the deposit process, or if you notice that there's been a change later in the process, you can go back to the original documents and see what was there. Final tip today, and this is a great tool, is to do surprise audits. So maybe your independent reviewer who reviews your bank statement would periodically do an in-depth review of some of your transactions or entries and compare them to supporting documents. So some of the key ones I would recommend, one would involve payroll. This would be especially important if you can't segregate the person who makes master file changes from the person who can process payroll transactions. You'd want to have somebody go in and look at wage rates. You'd want to see if there's any ghost employees. You'd want to look at the last few checks of terminated employees to make sure that they weren't overpaid or that their checks weren't deposited to somebody else's direct deposit account. You look for bonuses, and again, you look to make sure that tax deposits are made. Similarly with vendor files, if you can't separate the vendor master file changes from the vendor and accounts payable transactions, you'd want to go in and look at duplicate vendor names. Maybe you could download the data to Excel, look at duplicate vendor names or names that are very similar. So if you have, say, Saks Fifth Avenue is one of your vendors, and you had a vendor named Saks Fifth Avenue, and you had a vendor with the acronym SFA, those may be the same vendor. So you want to be aware of acronyms in your vendor names. You would want to look for duplicate invoices because that can be evidence of a pay and return scheme. If I'm a bookkeeper and I intentionally overpay an invoice or pay an invoice twice, I can call the vendor and ask them to issue a refund check, and in doing so, I can intercept that refund check if I'm the one that gets the mail, and then take it and deposit it in my account. And there are ways to do that kind of a deposit where it doesn't have to be made payable to me and I can still convert that to my use. Another thing to look for would be shell companies or fictitious vendors. I also recommend that this reviewer would periodically review your audit trail report if you have one, and as well as any journal entries that are being entered into the system. So if you have a journal entry report that you can look at, that would be fabulous, or look at some of your key accounts to make sure that they're not being altered or adjusted with inappropriate journal entries. The trust but verify principle embodies both accountability and transparency. So transparency, other people can see what you've done, and accountability is doing the right thing at the right time in the right way. It's not about mistrust. Internal controls are checks and balances. They are not about mistrust. They're about holding people accountable and keeping honest people honest. So this webinar is focusing on tools for deterring embezzlement, or to catch it quickly. Too much trust and too much oversight for the mother-daughter team in the nonprofit case study that we discussed earlier, as well as the public company with $40 million in annual revenue. Both those cases are examples of really poor or non-existent internal controls. So internal controls that are based on the trust but verify principle will help keep people honest and help your business or your organization achieve your goals and missions. You don't know what's going on in the lives and the hearts of your employees. You don't know their state of mind. You don't know if they're depressed. You don't know if they have an online gambling addiction, whether they just lost the kids' college fund in a day trading issue, whether people are getting ready to go through a divorce. So you want to counter that perception of opportunity that a potential trust violator would have and replace it with a perception of detection by using tools that will hopefully deter somebody from solving their problems with your money or to detect it more quickly if it does occur. So trust but verify. Now I'm going to turn it back over to Miranda.
Thanks, Denise. That was definitely some very good and important information to protect our viewers. And I did want to point out, in case you didn't notice, we do have Denise's slides for today's presentation listed here at the GoToWebinar under the handout, so you should be able to access those. If you have any problems, just let us know, but you can access those. Cougar Mountain Software believes your accounting system has an obligation to provide basic internal controls. Always look for in-depth user rights that encourage differentiated roles, a tamper-proof audit trail, as well as customizable reports to support transparency, education, and awareness. Our Denali and Denali Fund industry-specific accounting solutions offer all of the above features. Fraud is unpreventable. Fraud is unpredictable, but protecting your organization doesn't have to be. For a comprehensive demo and a list of features, go to cougarmtn.com and request a demo or call 1-800-388-3038. We will now open it up with a short poll so you can assess your organization's preparedness for fraud based on your industry and company size, and then followed by some questions and answers with Denise. So if you have any questions for Denise from today's presentation, go ahead and type those into the chat box, and we will go ahead. Looks like the polling is in progress right now. We have a couple of minutes or a minute or two that we go through with that. If everybody just takes a minute or two to kind of answer those questions, we should be able to assess here, the size of your organization, how large of your accounting staff, kind of note your industry, and then let us know and let yourself know where are you with, do you currently have Denise's recommended internal controls in place in your organization? Looks like. Just so you can kind of see where you are and use that as a benchmark against other organizations of similar size and industry to see if you have, to assess your fraud preparedness. Looks like we've got just a couple of minutes here for each question. A minute or so. 81% looks like voted. Looks like most of you have about 2 to 4 accounting staff. We'll display some of the answers for us. Good. Looks like Like a lot of you definitely have some controls that are implemented in your accounting software and internal controls.
Good for you.
Good, yeah. One final question here, and then we'll open it up for questions. Or one final poll assessment tool we've got here. So it's like a little bit more than half do currently restrict user security. So that there's different people that are responsible for processing checks and payroll and vendor payments are different than the ones who can actually make the changes in the master files. That's pretty good, Denise.
That's excellent.
Yeah.
Yes, that's better than I expected.
Okay.
Most of the organizations where I do an internal control assessment, that is virtually always a recommendation of mine. And it's not easy to do if your accounting software doesn't support that.
And I think that was our final polling question. I'm not sure if it's showing the results right now. Did you have anybody out there has any questions for us? And I know Denise might have one or two things based on the poll results that she might want to bring out and point out for us.
Well, it looks like there were, most of you have two or more employees in your accounting department. And once you get up to about 3 accounting department employees, you can start to institute some internal controls. With 1 or 2, it's much more difficult. But 3, and especially when you get up into 5, 6, 7, and 8, you can certainly segregate duties. If you're not able to segregate duties, you really have to rely a lot on oversight for your internal controls. And so having people reviewing different aspects of a transaction and not being able to control all aspects of a transaction is really important. And I would strongly encourage you to enforce your segregation of duties, at least what you can do, with your user rights. Because what I find when I do internal control assessments is that somebody who used to do the job but then moved on to something else still has the rights from their previous job. And so you want to make sure that when people move from one position to another, that their user security rights are updated so that they reflect their current job responsibilities and not their previous job responsibilities.
Did anybody have any questions, any follow-up questions for Denise that you'd like to ask? If you do, just feel free to chat those into the chat box now. And if that is it, we'll go ahead and make sure again to download the handouts that are right there available for you with the GoToWebinar. And we will also send a replay out. A replay will be sent out to you tomorrow with a link so that way you could access the files as well. And if you have not watched the webinar number 1, please go ahead and you can check that out on the replay page. And then we'll make sure to look for the notification for our 3rd webinar with Denise on the series for fraud prevention, and that'll be on March 7th on Tuesday at 1 p.m. So be sure to go ahead and mark that in your calendar and look for your invite for that. And without further ado, if that's all we have, wanted to give another big thank you to Denise McClure for joining us and sharing this information. And from Cougar Mountain Software, we look forward to seeing you next time. Thanks so much.